Good afternoon, everyone, and welcome to today's webinar, How to Sell Your Business, What Vertical Software Founders Need to Know, or I like to say should know. My name is Sylvain Perrier, and I'm Group Leader with Vertus, part of Constellation Software. First and foremost, thank you for taking the time at noon for joining us. We know that for many founders, the decision to sell a business is not purely financial. It's personal. It's emotional. It involves your employees, your customers, and a lot of times your best customers, those that have been with you since the beginning of your journey. It's your legacy and the company that you spent decades building, spending all those family vacations worrying about. Our goal today is not to give you a sales pitch. This session is meant to be educational and practical. We want to share what we have seen across real transactions, what founders should understand before they begin a process, and how to think about choosing the right, let me emphasize that, the right long-term partner. Now, for a bit of context, Constellation Software has completed more than 1,000 acquisitions since 1995, so many that I've lost count, quite frankly. And one of the things that makes Constellation different is that we operate as a permanent owner. We acquire businesses with the intention of holding them indefinitely. In fact, it is core to our DNA, and I've been here only for 6 months and certainly was really part of the early stages of my educational process of joining the organization. So today in our webinar, we're going to cover 3 broad areas. So first, we're going to talk about when founders typically begin thinking about selling, and there's a topic on our podcast, Build to Hold. Encourage you guys to subscribe to the podcast. Shameless plug here at the top of the webinar. And second, we're going to discuss how to prepare a software business for potential transaction. This is something that's always overlooked from organizations and people that want to sell their business. And the third is we're going to talk through what the sales process actually looks like, including so what happens after a transaction closes? That's really where the more difficult work starts to occur. So we're going to spend roughly 30 minutes in discussion. We'll do our best to leave 15 minutes for audience Q&A. There's a whole process that you can submit questions. And so one quick note before we begin, and this is from Brent Winston, our attorney. So I do have to put this out. And the guys are laughing because we're talking about Brent just before I hit the record button. Today's discussion is not legal, tax, or investment advice. Every situation is different. What we are sharing today is practical experience for people who have been close to many founded or founder-led software transaction. So with that, let's introduce our panelists today. I'll start briefly with myself. Before joining Vertus, I was president of North America and global chief operating officer of Vertus Technologies, a vertical software company heavily focused in the grocery e-commerce space. And today, as group leader at Vertus, I spend my time running a small portfolio of diversified organizations, and I get to spend time with Zach and his team in supporting the whole acquisition process. I'm joined by Zach Plener, our Senior Director of M&A at Vertus. Zach spends his time speaking with founders, evaluating vertical market software companies, and helping complete transactions. I know he's done 100 of these, which is awesome. He has spoken with tons of them, exploring succession, liquidity, and long-term ownership options. Zach, thank you for joining us today.
Thank you for having me. I'm excited.
I'm also pleased to welcome Sami Kabir, Managing Director of IJW Co. Sami brings an important external advisor perspective to the discussion today. IJW is a Canadian boutique investment bank focused on M&A advisory and independent valuation services. The firm was established in 2004 and has become a mid-market leader in M&A advisory, particularly in technology in the consumer sectors. Sami, thank you for being here today.
Thanks for having me.
Awesome. All right. So let's just jump right into it with that first part, which is the question that usually comes before a formal process begins. When does a founder start thinking seriously about selling their business? I know for me, it wasn't something that just kind of materialized overnight. It was something I was contemplating throughout 23. It was early 23, and I decided it was time to kind of exit out of Vertus and sell the business. But for many founders, like I was saying, it's not a single moment. It can start quietly, sometimes years before a transaction. You may be at the gym, you may be at family vacation, but it also may come from fatigue, succession planning, personal liquidity issues, or quite frankly, simply recognizing that a business needs a different kind of support to continue growing, which is entirely natural. Zach, I want to start with you. Now, I know you've had a lot of these conversations with founders, and so what are the most common reasons a founder begins considering a sale?
Yeah, so I would say it's an accumulation over time. So it's accumulation of multiple reasons, and I would say fatigue is probably the biggest one, and not burnout, but more emotional fatigue. The weight of being a decision maker and having many employees and many customers rely on you for 10, 15, 20 plus years, it takes an emotional toll on people, absolutely. And then I would say maybe succession is a second. So founders maybe don't have an internal succession plan, and they're looking for a group or a portfolio or a strategic partner that can help the business live on and really cement their legacy. And then I'd say the last piece is liquidity. And I would say less so from the valuation standpoint of they just want the highest dollar, and more so they've spent decades building this business, so all of their investments is in this one asset. So naturally, a lot of people want to, get some money off the table and diversify their personal net worth. So I'd say those are probably the most common, but there's always new reasons. I'm learning every day because everyone is very different, and I would say there's a very personal aspect to running and owning and operating a business. So it's really just being aware of, what are these concerns that I'm having, and how can I find the right partner to satisfy them.
Yeah, and it's so true the way that you position it, right? It's not that lightning moment. It's like, okay, it's time for me. Let me have a conversation with my board or my business partner. And let's not forget the family, right? A lot of these
Mhm.
businesses are long-term organizations where there may be a son, a daughter, a spouse, a partner working in the organization, and you tend to build up to it. Sami, from the advisor side, what signals do you see or suggest that a founder actually may be ready to explore a transaction, even if they're not like fully committed to sell the business?
Yeah, I think the ones Zach hit on are definitely some of the ones we see the most often, right? So succession, liquidity, those are primary reasons. Some that I would add, one is definitely the business having outgrown the founder itself, right? So you talk about the needs that are required for the business to be able to execute on its next phase of growth, right? The founder or the leadership group that's in place may not be the ones that are best fit to be able to take that business to that next stage, right? So that could come in the form of expertise, right? The business is growing globally. They don't have experience growing into international markets. It could be a capital reason, a capital related reason, right? There's a certain amount of capital or investment that's going to be required to be able to get to that next stage, and a traditional fundraise or traditional financing options are not going to suffice. And so those are reasons, in addition to everything Zach listed, that we also see people looking to pursue a partner or a suitor or a home for the business.
Yeah, and that's a really good point because an owner operator at $1 million, $2 million can be entirely different than a business that wants to operate at 10, 20, or 30 million. It's I always say every day is never the same when you're an owner operator, and certainly challenges and scope scales as you get bigger, you grow outside your geography, and the more revenue that you make typically requires more people. And so the problems become considerably more complex. So let's move into preparation. One of the mistakes that a lot of founders make, and I was one of those, so I'll fully admit to that, is assuming that preparation starts when you decide actually to run a sales process. When in reality, I think we all know this, is preparation should begin considerably earlier. And my view is a well-prepared company is easier to evaluate, easier to go through diligence, and usually gives a founder more control over timing and process. Now, Zach, when you're evaluating a vertical software business, what are the issues that are most commonly discovered once preparation begins?
Yeah, so I think of two categories. I think of strategically and operationally. So I think strategically, it's a discussion. So I don't see common strategic issues. I think that's more of a discussion as we work through the process to understand strategically what and where does the business want to go, and how can us as a partner, or whoever the partner is, get them to where they want to go. And I don't think the problems stem strategically. I think more of the issues we discover are operationally, which are easily fixable with people like Sami and with experts that help guide them through the process. So what I mean by operationally is like financials that maybe aren't closely like they're kind of a little messy. Maybe revenue recognition has got away from them over time. There's not a consistent operating expense model in terms of where they're classifying personal versus business expenses. Things that when the company was small, it made sense, and maybe as they scale, it makes a little less sense. And then you have the common problems like customer concentration. So we see that all the time, especially for founder-operated businesses. When they have started with one customer, that one customer will typically become their forefront. That becomes their behemoth that they're consistently serving, and every year adding on to the functionality and adding more, more dollars to the pocket that's coming from one customer. So I'd say that's a big piece that just requires conversation to understand and really explain, the relationship with said customer. And then I would say management depth maybe is a third piece. So strong businesses rely heavily on the founders because the founders will get pulled in a lot of different directions, and they're consistently working in the business rather than on the business. So naturally, what we try to understand, what I'd say most buyers will try to understand, is what happens when the founder takes a step back. Where do their responsibilities go? How do they navigate their responsibilities amongst their staff? And how can they continue moving the business forward? So I think if I classify those, they all sit in the operational front. And I think strategic issues or strategic concerns is more about how do we work through this together.
That was well said. So, Sami, I want to play a scenario with you in this. So, an entrepreneur comes to see you, has made the strategic decision to exit the market, not really decided. They do want to sell, not decided if they want to stay. So, where are you advising or looking at the areas that you want cleaned up first?
Yeah. So as investment bankers, there's sort of two things we need to focus on. One is a lot of what Zach's touched on, which is introducing operational advancements and efficiencies, as well as finding ways to reduce risk in the business. Right, take away the risks, take away the uncertainties that exist. And the other one is partially how do we tell the right story. Right, so as bankers, storytelling is a big part of what we do when we prep. And so in a perfect world, when you bring the two things together, you've eliminated a lot of the risks and the uncertainties, and you're able to take, look, no business is perfect, right? There is always going to be, there's some level of concentration with customers, some level of key person risk. There's going to be some challenges in the business. And so part of it comes down to how we're telling that story. So, to answer your question, Sylvain, the way that we always try and frame it is what can we do up front, whether that's months in advance or years in advance, to reduce or eliminate buyer friction, right? So what we want to do is be able to prepare in a way that from the lens of the buyer, we're doing everything we can to remove anything that can slow down or scare the buyer during due diligence. So again, Zach hits on, a lot of the points, so I won't repeat there, but in terms of the storytelling aspect, understanding that no business is perfect, right? Like, let's take customer concentration, for example. Let's say this founder has concentration in their business. How do we position that or spin that in a way that is actually positive, right? Like, for example, how long have these customers been a customer of the business, right? Are we talking months or are we talking decades, right? To what level is the solution embedded in the business, right? Is it a solution that's embedded deep into the software stack? Or is it a high-level reporting layer, right? So if we can figure out, exactly what makes the business special where it sits, we can find ways to not only, obviously, again, clean up and remove some uncertainties, but build a story around it that make even some of the shortfalls look like strengths, or at least have them not look like weaknesses.
Yeah, well, that's a good point, right? Because you're storytelling, you're identifying the risk right, where there could be friction, and then you're de-risking it. So is there, revenue concentration could be high with a small number of high profile, high paying customers. What's the likelihood of attrition? How deep is the relationship? What's the length of those contracts? And so that's good because in the long run, if you're going through diligence, that just speeds up the whole process, right? So it makes the management meetings that richer.
Yeah,
Zach,
so I was actually
go
going
ahead,
to
Zach.
touch on that because I think what Sammy's team does really well, and I'd actually define them as advisors and not the investment bankers. And by advisors, I mean the story that you guys tell. We essentially try to do the same thing. We try to figure out the story, and having people like Sammy tell the story helps us, to your point, when we get to the management meetings, really focus on the areas that need to be focused on rather than starting from scratch and really figuring out the story for ourselves.
So, Zach, when you look at strong businesses, so what stands out from a characteristics perspective?
Yeah. So I actually like the word boring. I think
Oh, okay.
boring businesses are the best businesses.
Okay. All
So
right.
what I mean by that, I mean it as a compliment. The boring
Mm-hmm.
businesses are the mission critical. They're enterprise wide. They're not point solutions. Sometimes they're back office. They're running behind the scenes. Obviously, high recurring revenue, strong retention, but a product that is built for an enterprise and not for a point or one department. So back office accounting. I mean, I do have an accounting background, so I'm a little biased. But the businesses that really work behind the scenes, I think those are the best businesses. The ones that help companies do a better job at servicing their customers and work behind the scenes and touch multiple departments across the organization are the best ones. And then I would say some other characteristics is when they really understand their customers. So really understanding what their customers want and the value and really the problem they're solving for their customers. The ones who really understand the problem they're solving for their customers are able to really narrow down on what is our platform offering and how are we solving that problem rather than adding all these layers of functionality that may not be useful or may not be as useful as really the core problem they're solving. And then I'd say the last characteristic I love, which maybe isn't a characteristic about the business and more so on the owner and the management team, is just clarity. So like people who have a clear understanding of their economics, a clear revenue model, and are very honest and open about where the business wins and where it doesn't win. Because us as acquirers, I think, yeah, we would love to help businesses, but really to help businesses, we need to understand where they may lack in some areas and maybe where they lose to see how we can be of service.
Yeah, I always kind of equated it down to businesses that operate as an operating system behind the scenes
Mm-hmm.
that are so deeply intertwined in the well functioning of an organization, you just can't wake up one morning and strip it out,
Yeah.
right? So for those of you, send us your boring businesses. We'll take a look at them, right? So new slogan for us for the marketing team to work on. Sammy, I want you to build on the same question I asked to Zach, but so from your perspective, what makes a software company attractive from a transaction perspective?
Yeah, look, I think it's a lot of what Zach's touched on already. We work with both boring businesses and some pretty exciting ones, and both definitely attract a lot of attention in the market. But yeah, I mean, mission criticality is always important. I think it's even more important today. I think I touched on how embedded a solution is within the business, within its technology stack, right? So when we're evaluating, and I know when buyers are evaluating, we're looking at how easy is it to rip this out of the system, right? Are switching costs low or high? And obviously, the higher the switching costs, the stickier the perception of the business should be. We look at things like, scalability is obviously a buzzword, but that's a big one, right? And so part of scalability is not just margin and its ability to capture velocity, but also things like frictionless implementation, right? Can it be deployed at scale, or does it require a lot of customization, right? So things like that, things that will create friction from rapid deployment, those are things that we'll evaluate to understand. And then I think lastly, just understanding what the moat is, and again, as the landscape changes, moats change as well, and so knowing what sort of moats exist and how that makes revenue durable, how it makes it how it makes it stick in turbulent times are things that we assess.
Yeah, I'm glad you call out the moat thing because as the dynamics in the industry change, geopolitically, technology wise, I mean, there's always outside forces that are imposing themselves on a market, on an industry, and certainly on businesses. It's important to take a look at those to understand the balancing act that any organization has to have with respect not just to what drives it to be attractive, but also what makes it durable in context. So let's walk through the sales process itself, right? For founders who have never sold their business, the process can really feel opaque and kind of murky, even the best of times. And there are multiple phases. There are multiple stakeholders: your accountant, your attorney, your tax accountant, your spouse, your partner, your kids, your shareholders, your board of directors. And there's always going to be a lot of information requests. So at a high level, a typical process has 6 phases. Now, the first phase is preparation. That includes organizing your financials, gathering business materials. And it really starts with getting the story documented in a confidential information memorandum. Complicated, but we use the word SIM as a short, but it starts sometimes with a teaser before you get the SIM. The second phase is buyer outreach. This is where like your partner that's helping you sell the business will kind of go after who could potentially buy this business. Is it a strategic or is it an investment firm? Is it Constellation Software? So it can be structured in a way that you just blast out there, or it could be let me make a few phone calls to see who might be interested. The third phase, and this is the daunting one. I remember going through this one in my first time. It's the buyer meetings, right? So this is the management presentations where there's detailed Q&A sessions where the buyer is going to try to understand your business. They're going to want to understand your market, the customers, your product, and who's the leadership team. I remember sitting in a hotel room. I was traveling. I was supposed to be on vacation, and ended up being 60 meetings over 5 days. Back to back, back to back, back to back, which is daunting. Not always the case. This was quite kind of special for us, but it is when I say one of the most important phases. That's where you're kind of going out there. The fourth one is letter of intent, LOI. It's a non-binding agreement that outlines valuation, the deal structure, timing, and some of the key terms. Fifth one is due diligence. This is where the buyer's going to want to validate financials, the legal, the technical, the commercial, contracts you may have with vendors, clients, and more so the operational details of the business. And the final phase is closing, where the final documentation is completed and the transaction comes to a close. And so in a well-run process, launch to close, Sami, is it 6 months maybe? Is it longer? Is it shorter? What are your thoughts?
Yeah, I would say 8 months is pretty average. I would say since post pandemic, it's deals take a bit longer to close. There's buyers have become more disciplined. They spend a bit more time in due diligence. So what maybe used to be 4 to 6 months pre-COVID, looks a little bit more like 6 to 8 months on average now.
So I want to ask you a follow-up question. Like, what should founders understand about running a process well?
Yeah, when we get brought in to help run a process, what we communicate, what we are really trying to do is anchor the process around having control and creating tension, right? And so what I mean by that is that a well-run process creates tension with buyers, timelines, and the options as well. So by tension with buyers, I mean being able to have negotiating leverage and to be able to negotiate not only value, but structure and terms that are included in the deal. And by tension around timelines, what I mainly mean there, and this one's extremely important to us, is being able to control momentum and control speed. So there's obviously a really well-known saying that time kills deals, and so we want to be able to move as quickly as possible. We don't want to stall. We don't want to be the reasons why we're stalling, right? Because we're not able to provide info, and we also don't want buyers to be stalling for whatever reason. And then the last one is creating tension around options. We want to be able to, we want our clients, we want, vendors, sellers to know the different types of buyers that are out there, the different type of offers that they can get, and also to have a contingency plan in the event that they are working with, let's say, a single buyer and things don't work out with them, then what other options do they have? Who else is around the table?
Zach, from your perspective, being on the buy side, what makes a process easier or harder for you to evaluate?
Yeah, so I love one thing Sammy said where he said time kills deals. And I completely agree. It's the processes are long, they're strenuous, there's lots of questions, and sometimes it pulls founders, operators, and owners away from the business because they end up fielding and they have to field questions and diligence through the process. So working with a professional buyer and professional companies to really get down to what's important and what isn't important, and then having upfront and honest discussions before even starting the process with that buyer, I think is important. It helps really minimize that time. But to answer your question, I would say it's all about transparency and honesty. So really understanding, no company is perfect. Every company is going to have some specific area of concern that needs to be worked on. Maybe concern is the wrong word, but some area where it can be improved, whether it's customer concentration or pricing or how their R&D team is spending their time or their use of AI. Like there's some form of improvement that every person in every business, including us, can continue to get better at. So I would say discovering those problems or those concerns earlier makes them manageable. And on this time kills deal concept, by understanding them early, it gets to the solutions quicker. So it's really getting to close quicker. So if those problems come up later and there's surprises late in the game, it's just going to extend the process, which nobody wants. They're stressful. And what our role is and what Sammy's role is to make them less stressful and really just get to that close and get them to a point where they're satisfied. So well-organized information, being honest, upfront, transparent, and then just being straightforward about the weaknesses and the strengths is going to make for a smoother process.
Sammy, how should founders think about whether to run a competitive process?
Yeah. I mean, look, I think that, and this is always our advice, is that to some extent, you should always be running a competitive process. So whether that's you making the decision that you want to explore the market, you want to, work with a group like ours to go out and explore the broader market, understand who the buyers are that are out there, what the valuations look like, et cetera. Obviously, buyers need to or sellers need to understand, that there is, some time commitment that comes with them running that process, right? The most important thing that they need to be doing while a process is being run is to continue focusing on the business. And one of the things that is impossible to avoid is that there is going to be a bit of distraction, whether that's distraction for themselves or distractions for folks on their team. There is a bit of that. So understanding that there is a commitment that comes with exploring a process is important, but it shouldn't deter you from running a process if you are interested in exploring a sale, right? On the flip side, I think that even if you aren't looking to run a hyper-competitive or broad process, understanding what your options are is still critical, right? Even if you are receiving, buyer interest that's inbound, you haven't looked to run a process, but they give you an offer, and let's say that offer is, would be otherwise acceptable, you still want to be able to make the most informed decision possible, and the way you do that is by, the way you find out what your other options are is by having select discussions with other parties in the market, understanding what your other options are, how the market perceives you. Even if you don't want to have several discussions, if you aren't talking to other market participants and you're only speaking to one, you're always going to have imperfect information. So understanding, what the market would bear if you were to speak to a few others, we think is always critical. So whether you're running a broad process where you're speaking to dozens and dozens of buyers, or whether you've received an offer and you want to just do a sanity check by speaking to two or three others, there's some level of competitiveness in that process that should always be there.
Okay, so let's assume transactions close and jump into what happens next. And I think this is one of the most important areas for a founder to understand, because the buyer model is going to shape life after a deal in any case, right? And it affects you as an individual. It affects how you participate and you show up on a day-to-day basis, how you're going to interact with customers, how you're going to interact with your employee base. And not all buyers are the same. And I think we do something quite special here at Vertus in terms of how when we acquire a business and how we work with the CEOs that have stayed on board. A private equity buyer may have one set of expectations around growth, leverage, certainly around exit timing, and quite frankly, a different operating model, versus a strategic buyer that may have a completely different set of expectations around, well, how am I going to integrate this business, product consolidation. No one wants to run 2 or 3 competitive platforms, customer migration from the platform that was being used by the business that was acquired now in terms of migrating over, and quite frankly, brand strategy, which is seeing your logo, which is your purpose North Star disappearing off the face of I'd say the face of the planet, but really it's not that wide. And so a permanent owner has a different operating model. And I'd say that would be us right here at Vertus. So, Zach, when founders ask you what life looks like after selling to us, how do you typically explain it?
Yeah, so the first thing I'll do is I'll direct them to our businesses and the people who've gone through it, because I obviously have not been through the process and I've never sold a business, and I'm very aware of that. So me explaining it is much different than people who have been through the process and we've successfully acquired. So that's the first thing I'll always do is I'll send them a Rolodex of people and say, call any of them without me and ask them questions. And I know all of them are going to have their pros and their cons about selling to us and what life looks like and looked like. And I'll be honest about our process. Like, we are always learning too. So we absolutely will make mistakes as anyone will, and then continue to get better as we run processes with more people. But how I would describe it is the permanent capital methodology is far different. So because of that, it's a long-term view on businesses and investing, where every decision we make is for the longevity of the business, so that the business is continuing to operate in 10 years, 15, 20, not just in 1, 2, or 3. And I'll be the first to say that our model is very different than the private equity firms or the strategics because it is more permanent. But with that, the focus is on preserving what already works and then making those small changes to departments or specific areas of the business so that they are long-term and they will be around in 5, 10, 15, 20 years. And I think there's a relief with that. So one thing that we do is when we enter diligence, we spend the first 30 days doing all of our learning. And then we have a halfway point where we sit down together, preferably in person with the businesses and with the founder and whoever from the management team they want there. And we talk about our learnings, findings, and changes. What do we think we can help with, and what areas of the business do we think we need to change? Whether it's pricing model, whether it's adding sales resources to enter a new geography, leveraging our other sales teams, leveraging our expertise. But there are changes, and it is a big difference from prior to close to post-closing. But you have our team that is really there to walk you through it every step of the way. So that's my answer, but I would always encourage people to talk to others who have been through the process, because I've never been through the process. They will tell you exactly how they feel about it, and they'll have some of the same concerns as the founders do.
Sami, a little bit different, but what are some of the misconceptions you pick up on that founders commonly have about post-transaction life?
Yeah. I do think that there is a misconception around the types of buyers. I do think until you're well educated around the different types of buyers and what their purpose is and what their vision for growth through acquisition is, or whether it's just portfolio building, until you understand that, it's hard to differentiate. And when you haven't gone through a transaction, Zach mentioned that he's never gone through one. The reality is that a lot of founders we work with, they haven't either, right? Not everyone obviously is a serial founder or entrepreneur. And so I think just not realizing that and understanding that there's different the post transaction reality is different depending on the buyer is definitely a misconception, right? The reality is that um, the right home for the founder depends on what the founder's objectives are. So like we've seen, I've seen pros and cons of all types from all types of buyers, and the bad situations are the ones where the cons are extremely misaligned with what the founder's objectives are, right? So ultimately, the seller and the seller's advisors, they need to know what the seller's looking for. Are they looking to maximize dollar value in the deal? Are they looking to de-risk personally while retaining control over the company? Are they looking to just bring in a strategic partner to scale? Are they looking to preserve legacy and the people that are really important to them? Understanding and aligning with those factors is ultimately what's going to set the exit up for success. And then the other thing I'd say, and I don't know if this is a misconception, but it's something that we see a lot as a shock or a surprise to founders post transaction, is just the concept from going from being your own boss, from being the entrepreneur, the CEO, or whatever title they may have, to then going and working for somebody else. And I think it's taken very lightly in the early days when founders talk about exits and then wanting to continue seeing that next phase without properly again diligencing what life on the other side looks like. And so I think to Zach's point, talking to others that have gone through it, or even talking to reference points within those buyers, right? So in Vertus's case, talking to founders who've sold companies to Vertus and then have either continued to work for them or didn't, like understanding what that looks like day in, day out, I think is really important when making the decision on who the right buyer is.
I I like the way you framed that, because it took me a while to prepare myself mentally to like, because I was struggling with the question, what am I going to do now?
Mhm.
Because I inherited a boss after 21 years of not having a boss and reporting to the chairman of the board. It's entirely different. And this next question, this one's for you, Zach. This is the first question I wrote when kind of writing out the outline for the webinar and the questions I wanted to ask. And I know this is one that has come up on my M&A conversations with people that are kind of deciding to go to that next phase. But what should founders look for when assessing cultural fit with a buyer?
Mhm. So I would say buyers will show their cards in the questions they ask. So as they go through the diligence process, really listen to the questions that are being asked. And you'll notice that there's probably two areas you can put the questions into. You can put the questions into just general, people who are just asking general boilerplate questions. And then you have that second, which is really digging into the specifics of the business and wanting to learn. So what I will say is, like Vertus, for example, has a high degree of businesses in the hospitality space. And we were lucky enough to work with Sami on a successful transaction for another business in hospitality. And even though we have background in hospitality, let's say we meet with a business in hospitality, it does not mean that we know anything about that business, the customers they serve, and the products they're offering, even if we have expertise in that sector. So the questions, whether they're an expert in the space or not, should really be focused on customers, people, product, and diving deep into the business to get a really good understanding of it. And I think when people come prepared to management meetings with directed areas of focus and questioning, that shows their true colors of we really want to understand this so we can kind of get aligned on what it is. So I think just really listening to the questions being asked is a big piece. And then I would say the other piece is culture shows up in decisions. So maybe unorthodox, but to flip a question back at you, Sylvain. So you've been here for 6 to 7 months, and since then you've already acquired 2 businesses within your portfolio. And Sami made a really good point. He said this is the first time they maybe have ever had a boss. You being that boss, what are some of the things you would say, maybe from a Vertus perspective, that we differ in culture and how we run and operate a post-closing process?
Yeah, to me, it's always been. I always position myself as your virtual chief operating officer. I'm here to help you remove obstacles so you can focus at being really good at what you do. And so when I look at our culture, if you look at the core of Vertus, yeah, we're a lot of people, right, spread across all the businesses that we own today. But if you look at the core, it's a small number of people, and it has an appreciation for learning and challenging status quo, but in the most friendliest of ways. And I think people appreciate that, certainly with the two businesses that we've brought on board into my group. We've been able to compress the day after to really small focus on onboarding them and making them feel welcome so they can perform and grow what they do. And a lot of that is because that's how we operate on the day-to-day here. And so that just permeates itself out. But it doesn't, it's, I go back to a conversation I had with one of our business unit leaders the day after, and her feedback was, I kind of feel a little bit numb, like, what do I do now? And I'm like, so I honed in on that and said, no, that's absolutely okay. But you're still in charge of the day-to-day. That hasn't changed. I'm here to partner with you to help you out. It's a great question. So let's go into rapid fire before we open up to audience Q&A. So Zach, first question's for you. What's the biggest mistake founders make when selling their business?
Yeah, so I would say it's preparation. So preparation is key. So once you start the process without preparation, without really asking themselves the difficult questions and figuring out that story that they want to tell. So I'd say preparation is key.
Great. Sami, same question.
Same answer, but I'm gonna answer it slightly differently. So preparation, but how long prior to the sale you actually start preparing? Because we see companies that start preparing 3 to 6 months before they want to go to market, and we work with companies that start preparing 3 to 4 years before they go to market. We always prefer the latter, right? One thing that we always want to have our clients frame mindset wise is that you want to build a business that is going to be bought, not a business that's going to be sold, right? So if you start preparing 3 months before you go to market, your buyers may not know who you are, and so you do all the prep within a very short time frame, and you start knocking on doors, and there's a lot of unfamiliarity with who you are, what you've done, and so then it takes time to build conviction for a buyer. On the flip side, if you start preparing 3-4 years in advance, not only do you have everything internally, you have all your ducks in a row, but we can start helping build relationships with strategic buyers and financial sponsors years in advance, right? And so what ends up happening is that you're now you get tracked, you're on the radar of these buyers. They're watching you and your business evolve over time. They're seeing you hit your targets, hit your milestones. And so, you're almost building a market for yourself years before you ever actually go to market. And so time in preparing and planning is something that we often see it falls short.
Awesome. Thank you. Excellent takeaways. Now, for founders that are listening today, or maybe watching this on a replay, the consistent theme is don't wait till you're forced into a decision, right? Starting conversations early gives you more options, more leverage, and more control. And it doesn't have to be transactional. Selling your business does not have to be transactional. I think we're the friendlier side, I like to say, right? So we're not going to go to audience Q&A. Submit your questions through the Q&A function, and we'll get to as many of those questions as they come in. I'm not going to lie, it's my first time clicking on this button, so I have no clue what's going to happen. Okay, all we got is a bunch of hellos from Jay Williams. Hello, Jay. Let's see if there are any questions. So while we wait for questions, Zach, I'm going to ask you a question here. What are you seeing with the market conditions affecting valuations, especially in the VMS world?
Yeah, so we can talk for hours about AI and the SaaS apocalypse and what everybody's seeing in the market. But I would actually go the other side, and I would say it's just creating more selective buyers. So more disciplined buyers that are looking for specific types of companies that, again, everything that Sami and yourself and I have touched on in terms of mission criticality and enterprise-wide functions that are really hard to strip out. And I think that, yes, everyone can talk about how AI is impacting their businesses. I am on the fence that I don't think AI will replace software, because I think you'll need an expert and a partner to provide you with mission critical platforms that help you do your job better and help you service your customers better. So I think it's just creating more selective buyers that are really more financially disciplined in how they form valuations. But I would say the market's still strong. Like, we're still seeing a ton of opportunities come up, and we're still participating in very competitive processes, but they're more selective in the types of businesses that they're looking at.
Great. I want to thank everyone that joined today. I especially wanted to thank our guests, Zach and Sami, for sharing their perspective. There are 3 key takeaways I want to leave you with as we end the webinar. First, begin preparing earlier than you think. Even if a sale is years away, the work you're going to do now can actually materially improve your options later, and especially make those conversations a lot richer and a lot less friction, as Sami kind of called out. Secondly, the right buyer matters as much as the right price. I mean, it is your legacy that we're talking about here. The buyer you choose will influence your people, your customers, your product, and more importantly, your legacy. Third, the best transaction happens when founders actually get to control, to the best of their capabilities, timing. So when you prepare early, build the relationships early, and understand your options early, you put yourself in a stronger position. So if today's discussion resonates with you, we're here. Just reach out to us. And more importantly, follow us on our social channels. And I'd love if you subscribe to our podcast. Zach, episode 1, right? Built to hold. So it's great. Thank you again for joining us, and enjoy the rest of your day.